So this week we get to talk about the audit risk model, kind of our first conceptual idea that we're going to have in this class, and we're going to bring forward everything that we talked about so far, right? You're also going to have a quiz today. You'll probably have one on Wednesday as well. We need to get more in so you can drop more. This quiz is going to be over what we went over last week and some of the things that you should remember in this class. Only 4 questions, right? So the audit risk model, before we get into that, we really have to understand what audit risk is. And so we're going to explore PCAOB standard 1101. And according to this standard, right, what must an auditor do to form a basis for their opinion? What do they have to do according to PCAOB 1101? Nikki, I'm gonna repeat what Nikki said just in case you guys don't have it in your notes and you guys didn't hear it. She said that an auditor has to plan and perform an audit. That makes sense. Can't have an audit opinion if they didn't do an audit. We know auditing is a systematic process, so there should be a plan, right? So an auditor must plan and perform an audit to obtain what? Reasonable assurance, right? About whether or not the financial statements are free from material misstatement, no matter if that's due to error or fraud, whether it was intentional or unintentional. The auditor must plan and perform an audit, right, to obtain reasonable assurance that the financial statements are free from material misstatement, that there are no material misstatements in the financial statements to a reasonable degree, right? Notice that it's reasonable assurance that the auditor has to obtain, not absolute. How does an auditor do that? Reducing audit risk to an appropriately low level. And they do that through exercising professional care, getting sufficient appropriate evidence. But the point of it is reducing audit risk to appropriately low level. We're going to talk about, so what is an appropriately low level? Exactly. Okay. Before we do that, let's go back and define what audit risk is, right? We're going to be discussing the audit risk model. What is audit risk? The risk that the auditor would express an inappropriate opinion when the financial statements are materially misstated. When the financial statements are materially misstated. So that means that there's a really big problem in the financial statements, right? It means that there is a material misstatement according to that definition, right? So if there was a material misstatement in the financial statements, inappropriate opinion. We're talking about audit risk, right? Risk of giving inappropriate opinion when what? When there is a material misstatement in the financial statements. Financial statements are materially misstated. That was the definition that Tamia gave us. So my question to you, the follow-up was, what would that opinion be? What would be an inappropriate opinion if there's a financial, if there is a material misstatement in the financial statement? Yes, that's why this is called a risk, right? Yes. It's the audit risk is the risk that the auditor gives the inappropriate opinion when there is a financial or a material misstatement in there. So we're discussing the risk, not what the auditor has to do, the audit risk. So my question is, what is this? Of all the opinions that we went over before, only one of them would the auditor give if there was not a material mistake, right? So if there is one, they should not be giving an unqualified opinion, right? So you can take it and erase this and say unqualified. The risk that the auditor gives an unqualified opinion when there is a material misstatement in the financial statement. Right? Does that make sense? Yeah. In the audit report, they give an opinion always, and it's either going to be unqualified, qualified, disclaimer, or adverse. Not that they think they are. This is a risk, right? Like the risk is you go outside when it's raining and you slip and fall, right? It's a risk. So audit risk is the risk that the auditor gives the wrong opinion when there is a material misstatement. So if there's a material misstatement in the financial statements, what opinion should the auditor give? What would be the right opinion? Adverse is one of them. Qualified, right? And disclaimer. Because remember when we wrote those 3 or 4 opinions on the board, we said that one of them, it doesn't matter if there's a departure from GAAP or a scope limitation. If it's not material, it's unqualified. If it's material and compartmentalized, no matter if it's a scope limitation or a departure from GAAP, it was qualified. If it was a pervasive material departure from GAAP, it was adverse. And if it was a pervasive material scope limitation, it was a disclaimer of opinion. In this case, the definition of audit risk was the risk that the auditor gives the wrong opinion when there is a material misstatement. If there's a material misstatement in the financial statements, the auditor should either give a disclaimer, adverse, or qualified. So the wrong opinion when there is a material misstatement would be them given an unqualified opinion. Auditors are supposed to, right? It's their job to detect material statements. So audit risk is that they give an opinion that says everything's all good, but there is actually a material misstatement in the financial statement. Anthony? You can't say that. Because maybe they did detect it and they gave the wrong opinion. So this risk is specific that they gave the wrong opinion. Detection risk is the risk that they don't detect it. That's a different risk. That would not be audit risk. Why? Because the objective of an audit is to what? To obtain reasonable assurance that the financial statements are free from material misstatements, right? If you're telling me that the other way around is there is no material misstatement, that wouldn't be audit risk because there is no material misstatement. It's a audit failure because they gave the wrong opinion. They say everything is bad when it's not, but it's not an audit risk because there is no material misstatement. The people who get the financial statements are going to see the actual picture. That's a good thing. So it's not necessarily the other way around. No. Audit risk is specifically that the auditors give a good opinion when everything's bad. Audit risk is the risk that they give an unqualified opinion when there's material misstatements in the financial statements. There's problems there that are material, right? And they said everything was all good. So that if audit risk is the risk that an auditor on the audit report says there are no material departures from the GAAP, no material scope limitations, no material misstatements. Yes. Yeah. That's the problem. That's the risk, right? So the definition of audit risk is the risk that the auditor gives an inappropriate opinion. Remember, that's how we started this definition. Then I asked you, what is the wrong opinion in this case? Well, if there's problems, an inappropriate opinion would be to say there are no problems, right? So audit risk itself is a function of 2 things. Detection risk is one of them, and risk of material misstatement. Very good. Audit risk is a function of, remember when we talked about control risk, we said control risk was a function of operating effectiveness of control. And well, we'll talk about that later. When we talked about detection risk, we said that's a function of the auditor's procedures and how well they perform those procedures. Well, here we're saying audit risk is a function of, going back to our algebra days, audit risk is a function of risk of material misstatement and detection risk.